Welcome and thanks for joining this talk on why asset allocation matters in funds of funds. Over the next slides, we'll unpack how allocation choices shape returns, governance, and day-to-day operations, and I'll share a practical blueprint for translating mandate into portfolio action, so you can see how strategy becomes measurable outcomes. Think of asset allocation as the governing blueprint that connects capital calls, a defined risk budget, liquidity buffers, and return expectations into one coherent process. This slide shows how those inputs funnel into allocation decisions that both deliver fiduciary duty to limited partners and make performance attribution transparent and defensible. Here we outline a practical allocation framework where managers set strategic targets within permissible bands, codified in the LPA, and concentration limits. Those bands enable compliance while preserving tactical flexibility, so portfolios can adapt to market cycles without breaching investor mandates or concentration constraints. Choosing underlying funds starts with qualitative due diligence, vetting track records, spotting style drift, and checking capacity limits, then converts those judgments into portfolio weights via scoring, and finally maps desired factor exposures to the best available managers to build an optimized fund of funds aligned with strategy. Layered strategies reduce volatility and capture illiquidity premia by combining uncorrelated exposures such as buyouts, venture, distressed, and secondaries. The diagram shows how vintage diversification smooths returns, diversification shields against single fund blow-ups, and consistent access to private markets can deliver a dependable premium over time. Empirical decomposition shows allocation choices explain the majority of FoF return variation, while manager alpha is a smaller contributor, so the strategic takeaway is clear. Disciplined allocation and tilt decisions drive value more than relying on finding outlier managers, especially in stale vintages. Operationalizing allocation means turning strategic weights into daily workflows. Robust cash flow forecasts cascade into triggered capital calls. Treasury set liquidity buffers for follow-ons, and consistent valuation policies, all creating an audit-ready data trail that satisfies regulators and LP reporting requirements. Integrated portfolio management relies on real-time monitoring and an automated rebalancing engine that issues alerts, sells secondary stakes, or reallocates distributions when triggers fire, keeping portfolios inside covenant limits while eliminating manual spreadsheets and reducing operational error through a unified platform. Superior fund of funds performance is earned at the allocation table. Set clear strategic weights, enforce them with rigorous technology and governance, treat manager selection as an expression of those weights, and you convert diversification into transparent, audit-proof returns with reduced volatility for limited partners.